Hey guys, how are you? Welcome to another episode of Daily Risk. Indicators are still considered as one of the most used tools in technical analysis by traders. For this reason, we are going to introduce one of the most important oscillators called MACD indicator in this article. One of the most important issues in technical analysis and working with tools like indicators is the timing of their use. Unfortunately, many analysts are unaware of the right moment to utilize indicators such as MACD. This can lead to an unsuccessful trade for them. However, this to some extent depends on individuals' approach and strategy. This episode is divided into 4 parts. In that case, we can examine each part separately and explore the best strategies for use MACD in each section. If you are used MACD in financial market analysis and trading, stay with me to learn the best MACD strategy with the highest win rate. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel. If you are new, see you after intro.
Traders. For this reason, we intend to introduce one of the most important oscillators named the MACD, Moving Average Convergence Divergence, indicator in this article. The general concept of MACD. The MACD indicator was defined approximately 50 years ago by a professional trader named Gerald Appel in 1970. Another name for the MACD indicator is the Moving Average Convergence Divergence indicator. The MACD indicator is among those indicators that examine and explore the momentum of price movements. These indicators are referred to as trend indicators. One of the distinguishing features of the MACD indicator is its ability to examine trends and momentums simultaneously. To achieve this, the MACD indicator subtracts the moving averages in smaller intervals from the moving averages in larger intervals. In the definition of the MACD indicator, momentum refers to the fluctuation of price movements over time periods. Identifying price momentum in the forex market is a crucial tool for traders. The effective components of the MACD indicator. The formation of the MACD indicator involves the simultaneous use of 3 moving averages. These moving averages are defined for different time periods: 26 days, 12 days, and 9 days. The moving averages in the MACD indicator are derived from the closing prices of the asset. Additionally, what you observe as a trader in the MACD chart are 2 curves: the signal line, a 9-day moving average, and the MACD line, the difference between the 26-day exponential moving average and the 12-day exponential moving average. Along with these 2 curves, there is also a MACD histogram chart. Histogram. If we subtract the values of the signal line from the values of the MACD indicator, we obtain the histogram chart. Based on this, if the MACD line is above the signal line, the histogram values will be positive, and vice versa. If the MACD line is below the signal line, the histogram values will be negative. These periods can be changed according to the trader's preference. Each trader can define specific periods according to their conditions and needs, and based on that, define their own customized MACD indicator. Guide to working with the MACD indicator. The MACD indicator fundamentally examines the convergences and divergences of moving average values. In general, when 2 moving average curves move towards each other, convergence is said to occur. Movements of the 2 moving averages away from each other over time signify divergence. It's important to remember that the shorter the moving averages are, the faster their movements will be. For example, a 26-day moving average identifies price movements with a slight delay. Whenever the short-term moving average crosses above the long-term moving average, a crossover is created. It is at these crossovers that the histogram changes direction. Additionally, the MACD indicator oscillates around the 0 line. When the MACD indicator is positive, it indicates that the values of the short-term moving average, 12-day, have surpassed those of the long-term moving average, 26-day. The greater the divergence of the moving average values, the steeper the slope of the MACD line. Intersections refer to the points where the MACD line intersects with the signal line. MACD intersections are categorized into 2 groups, positive and negative. In positive intersections, the MACD line cuts above the signal line. Subsequently, after crossing the signal line, the MACD line moves upwards. In bullish intersections, The 12-day moving averages are positioned above the 26-day moving averages, and the histogram chart becomes positive. Generally, a buy signal is issued when the MACD line moves upward and crosses the signal line in the area below the zero line. A sell signal is issued when the MACD line cuts below the signal line in the area above the zero line. When trading with the MACD indicator, attention should be paid to certain points, which are briefly mentioned below. Points to consider in technical analysis when buying. The MACD histogram should show an increasing trend for buying. The MACD indicator should have reached the buying saturation stage. The values of the 12-day exponential moving average, EMA, should be higher than the 26-day EMA. Points to consider in technical analysis when selling. The MACD histogram should show a decreasing trend for selling. The MACD indicator should have reached the selling saturation stage. The values of the 26-day EMA should be higher than the 12-day EMA. Divergence analysis. While the MACD indicator can be a crucial tool in technical analysis, it shouldn't be the only tool used. Professional market analysts use tools like price action analysis alongside the MACD indicator. Price action analysis focuses on historical price fluctuations and helps us analyze and predict market trends based on them. Signals derived from price action analysis are reliable. Therefore, when the values of the MACD indicator show significant discrepancies with the values obtained from price action, divergence occurs. Bullish and bearish divergences. The MACD indicator can anticipate two scenarios, bullish or bearish, during divergence. In bullish divergences, the asset price or stock reaches lower values than the MACD indicator. Both parameters' values are lower. As the asset price decreases, the downtrend intensifies accordingly.
So guys, that's it for this video. In the next video, I will show you one of the best strategy with MACD indicator. I hope this content was valuable to you. If it was, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel for more content like this. See you in the next episode.